Welcome back to AI for Founders. I'm Ryan Estes. What happens when $4 trillion in private company wealth gets locked up, and founders, early employees, and investors can't touch a dime of it? That's the problem today's guest, Greg Brogger, decided to solve. Greg is the founder of Collective Liquidity, a platform that finally lets its employees and founders of late-stage startups turn their equity into actual wealth without giving half of it away to taxes. Before Collective, Greg built SharesPost, which merged into Forge, the first major secondary market for unicorn shares, and he's back to disrupt private markets all over again. In this conversation, we dig into the math behind diversification, how only 38% of Series C companies will ever deliver value, and why founders need a parachute before their IPO dreams crash. If you're a founder, operator, or startup employee sitting on equity and wondering how to turn it into real freedom, this episode is for you. Now, if you love conversations like this, join the newsletter at aiforfounders.co. This is where we turn complex startup wisdom into founder-friendly playbooks every week. It's where the smartest founders go to stay ahead of the AI curve. Your inbox deserves an upgrade. Subscribe now and make it happen at aiforfounders.co. And hey, if this episode teaches you something new, drop us a 5-star review so we can keep building this founder-powered universe together. Now let's talk about your voice. You've built a business worth talking about, but are you actually being heard? At kitcaster.com, we book entrepreneurs just like you on top podcasts that your future customers already listen to. And that's not an ad. It's not a pitch. It's a conversation that builds trust faster than any ClickFunnels ever could. Now imagine your story shared on shows your dream clients binge every week, positioning you as the expert, the authority, the founder who gets it. Kitcaster has placed thousands of CEOs, founders, and creators on the world's biggest podcasts, and now it's your turn. Head to kitcaster.com/application. Tell us about your business, and we'll take it from there, because your next $1 million opportunity might just start with a single interview. That's Kitcaster by MoBurst. Now, you and I know startups aren't built in boardrooms. They're built in the wild, during 3 a.m. bug fixes, botched launches, and that one meeting where everything almost fell apart. That's what Code Story is all about. It's a podcast where tech founders break down the make or break moments behind their products, what went wrong, what went right, and what nearly wrecked everything. Hosted by Noah Labhart, Code Story goes past the highlight reel and into the honest stuff. Late pivots, brutal bugs, and somehow coming out alive with a product people actually love. If you're in the build stage, or the scale stage, or the please let this feature work stage, I can relate. This show will speak to your soul. Listen to Code Story at codestory.co, or wherever you get your podcast, just search Code Story, it'll be right at the top. Because great startups aren't born, they're forged, one hard moment at a time. codestory.co. Greg, welcome to the show. Thank you so much for joining me.
Thanks, Ryan. Great to be here.
Absolutely. Now, we spoke before, which is rare for me, so I'm excited about that. I know it's going to be a really important conversation. I love learning more about your company every time we do, but I wanted to start with some personal anecdotes because I was doing a deep dive research on Greg Brogger. You know, I want to be prepared in what I'm doing, but I couldn't find it. It says GPT and Perplexity and Gemini could not find reliable public sources describing Greg's hobbies, off-work activities, or personal interests. So just start us off, Greg. What do you like to do when you're not working?
That's a good question. So I live in a really beautiful place up in Northern California in Marin County, where I think mountain biking was actually invented, or at least that's what all the bike shops around here claim. And so there's just miles and miles of trails. And so I'm either hiking or biking or at the beach. I just, half the reason to live here is to do one of those things. So that's kind of, that's how I clear my head and, get a little exercise and hopefully live a good life here in Marin.
Incredible. Now, that's kind of a controversial statement because I'm in Colorado and I believe Cresta Butte also lays claim to being the first mountain bike company.
Yeah.
Either way.
Yes, I imagine there's maybe more than one place they thought to put a bike on a mountaintop and write it down. But it's a couple of distinguished locations for mountain biking in the country.
Yeah, anywhere you've got like a group of guys with extra time on their hands and a few too many bikes, they're starting to
Yeah.
tinker, in the
And
70s and
a
80s.
trail or two. Yeah, exactly. Yeah. Yeah.
Cool. That's awesome.
Yeah.
Mountain biking, are you kind of like a cross country guy? Or you done any of the downhill stuff?
I'm just a recreational. I'm just
Yeah.
happy to stay up on my bike, and so if I can be on the trail and going up and down without any major injuries, that's about as far. It's like my ski level ability. Like I used to be a little bit more aggressive, and my son, we lived in Park City for a number of years, and they probably also claim to have the first mountain bike, I'm sure, but. And so he's now doing double black diamonds and skiing off trail and wants me to go with him because he wants a wingman. And I'm just, I have enough risk in my business and startup life stress that I just want to be, when I'm on a mountain bike or skiing, I just want to be relaxed and kind of enjoying the scenery, really.
Yeah. Well, you got a buddy in Colorado, because that's my speed. My son, he always wants to go extreme. And I'm like, son, I want to go medium,
Yeah, exactly.
medium to medium light. You know what I mean?
Yes.
Like,
Well, they fall and they bounce back up. I fall and my bones shatter, and the same to Sue on a bike. So the risk reward is a different calculation for us, I think, at our, or at least at my age, I guess.
totally agree. Totally agree. Amazing. Okay, let's start in. Give us a brief overview of your company, Collective Liquidity.
Sure. Yeah. So Collective is a platform for primarily employees of venture-backed companies, late-stage venture-backed companies, to obtain, sort of de-risk their over-concentrated position in their company. If they've got stock options, or if they're a founder and the bulk of their net worth is all tied up in one company's shares, everyone knows that's not a good idea. No financial advisor will recommend that. But it's really hard to take these illiquid shares, even of really successful companies, and turn it into a diversified portfolio that can be the basis of a long-term financial plan. And so we have a fund that allows people to do it, not just to exchange shares for a diversified position, but to do it in a tax-free way, which is really what's amazing. Because the difference, for most founders and employees of these companies between a tax-free and a taxable transaction, say a stock sale, is, in California, it's 46% state and federal tax rate if you don't have long-term capital gains, which most of our clients don't. So, that's the first thing we do. And the second thing we do is, if you need liquidity, if you need cash to buy a house or start a new business or whatever, we partner with a number of financial institutions and have our own program to provide liquidity using not the shares of the company that they come to us with, but the LP interest that they get from the exchange. And because it's a diversified portfolio and it provides quarterly liquidity, the borrowing costs are much lower than any of the single stock loan providers out there.
Okay.
So diversification and liquidity. I should have just started with those two words. That's what we do.
Great. And the liquidity, so like if you did want to, you want a down payment for your house, if you're in California, you're still subject to that 46%. Is that correct?
That's exactly right. Yeah, if you don't have long-term capital gains, and there's everyone's tax situation is a little bit different. What's their AMT situation? Do they have ISOs or NSOs? But even pretty much in all cases, the tax savings is a very relevant number. Plus, we don't charge brokerage fees, so it saves you another 4 to 6%. And those differences in our fund compound over time. So the difference between assign the same value to shares, say, $100 worth of shares, put them in an exchange fund and compare what that looks like 7 years down the road to if you took the same $100 worth of shares, sold them, pay tax, and then bought diversifying assets. And it's 2 to 1. And that's just because it's just the power of compounding. Those tax savings, whether at 46%, year 1, year 2, year 3, it just is building and building and building. So you can get literally twice the after-tax return or after-tax wealth if you work through an exchange fund rather than a stock sale. And look, public company executives have known this for a long time. So any really sophisticated financial advisor at Morgan Stanley or Goldman Sachs or any of these sorts of places, if they have a public company executive, will use an exchange fund as a way to diversify them because the tax savings is so powerful. But this Collective is the first exchange fund in the private market, the first exchange fund that will accept private company shares into its portfolio.
Interesting. And why do you think you're the first? Why has nobody kind of bit off this problem before?
Well, it's a complicated problem. There's a lot of tax and legal structuring that we had to figure out, and it's kind of part of this kind of larger theme, I would argue, around the private market generally, or the venture ecosystem, if I can still use that word. Because, look, if you go back 10 years, maybe a little bit more now, before private companies started staying private as long as they did, and we had this kind of massive increase in the number and value of unicorns, venture was not exactly a sleepy backwater, but kind of private equity. And so if companies are going public by the time they're, 4 or 5 years old and $300 million in market value, then, you don't really need wealth management products, because by the time they have any wealth, they're already a public company and they can use public company exchange funds and all the other wealth management tools that have been around for a long time. But if you then fast forward and now you have $4 trillion, sort of the latest numbers that I see from CB Insights, in aggregate market cap tied up in venture-backed companies, then, you're in a different world. And if they're taking 10, 12 years, you've got, both demand from the employees of these companies and a market size that, makes it, viable to create a platform like what we've created at Collective.
And you had a really interesting blog post that kind of illustrates this by taking a look at, what was it, 2010 to 2015 Series C companies. Maybe pull those statistics out, because I think that really paints the picture well.
Yeah, it's interesting, and it's the kind of conclusion, just to kind of skip to the end and I'll work backwards, the kind of conclusion that we all understand, that holding on to a single stock is much riskier than a diversified portfolio. We all get that, but just the extent of it, the math, until you actually do the math and do the research, it's kind of, or at least it was surprising to me. So yeah, we looked at a cohort of every US company that did a Series C financing between 2010 and 2015. So a decade later, 2025, we looked at how many of those Series C companies had actually exited, produced value for the employee shareholder for their shares. And it was only 38%.
Yeah.
Yet, if you had invested in every one of those Series C companies, you'd have over a 5x return on your investment.
Yeah.
So, it's difficult, I think, for a lot of employees of these companies that love their companies, or obviously if they're a founder, it's their baby, and they, things are going really well. They've just closed a financing, and they feel like, the sky's the limit. And in a sense it is, but just realistically, that's what every Series C, CEO of a Series C company thought to themselves when they closed that round. And the reality is, a decade later, 62% of them had yet to produce value. So, but if you had access or exposure to all of those companies, you would have created real wealth. And so we don't typically suggest that a founder or an employee trade all of their shares, right? In fact, I'd say on average, we only want to accept something like 15 to 20% of a customer's shares into the fund, but it creates a floor under your net worth. And it also allows you to create liquidity, and there's all kinds of other wealth management solutions that can be keyed off of our fund, things like donor advised funds and charitable remainder trusts. Again, all of the kind of wealth management strategies that are commonplace for public company executives, but just not been available to private company executives. You've been kind of tied to the mass, all or nothing binary outcome. And again, that's fine if it's a 3 or 4 year run, but if you're going to spend 12, 15 years of your life building a company, you really can't afford a miss.
Yeah, you need a parachute.
Yeah, a backup plan. Yeah.
You bet. So is the customer then the company itself for you, or is it actually the individual contributors of the company, the staff of the company?
Yeah, well, it's not to be difficult, but the answer is it's kind of both, right? So certainly the transaction is with the company, the transaction is with the employee shareholder. So they take $100 worth of shares in their company and they trade it for $100 LP interest in our fund, and everyone else does that. That's in the fund, so that's how you get the diversified pool of venture assets. So we could talk about how we pick the companies that are eligible for exchange, but almost every venture-backed company at this point has the ability to accept or deny a secondary transaction, or to accept or deny a new shareholder under the cap table. And even where they don't, we don't really want to do an exchange or work with a company where we're not seen as a value add player to the cap table. We're not sort of working with the company to enhance the value of their equity compensation plans.
Sure.
So, we need to basically win both audiences. And the way it most often works, like we work, our network, and we have an amazing investment committee and board and others making introductions, and we're working with now nearly 30 odd companies with our program. But very frequently what happens is a mid-level executive will find us on the website, or find us one way or the other, a referral or something, and will enter into a transaction, and all of the transactions before they're obviously consummated, before they're closed, get submitted to the company. And frequently what happens is the company will say, well, this is different. What's an exchange fund? We haven't seen something like this in the private market. How does it work? And so that conversation happens with the CFO, and the CFO frequently will bring the CEO and think, most of the time, at least the great majority of the time, I think this is a great idea. We could really use this. This helps our employees in a very real and unique way. And so that then kicks off a company discussion about a program. And so that's where we'll start talking about having the company direct us to allocate whatever exchange eligibility we have for that company amongst employees at their discretion.
Yeah. How does kind of vesting periods fit into this? So if I was granted, $100 in equity in the company, but I have 36 months for it to fully vest, do you have to wait that period before it's eligible?
Yeah. So there are some players out there that get super creative with, sort of ways to work with unvested shares or to work around the bylaws of the company or find ways to basically, by contract, lock up shares rather than have the shares actually transfer in their name to their fund. But we don't do that one. It's not generally viewed favorably by the companies that we want to make our partners. And it just creates uncertainty because you don't actually know that the shares are going to vest, or if you're doing like a forward contract or something, super creative, you've just got all these, you've got a contract, but if the shares don't get delivered, you got to chase people down. So we haven't resorted to that, I guess.
Yeah. Totally.
So we own all of the shares that are in our portfolio outright.
Cool. Love it. So this seems like such the no-brainer term gets thrown around all the time, but like this is a win-win-win for everybody kind of product. Yeah. What were people doing before? If you guys are the first one, what were somebody doing if they came up, super cash short and they're a multi-millionaire on paper, but like they can't get rid of the stock? Like what were they doing?
Yeah. Well, you had sort of two primary alternatives, and both of them are still around in the market today, right? And so actually, we started, much of the team that's at Collective with me has been with me with one or two companies in the private market space previously. And so we started the platform SharesPost back in 2009, which was the first basically marketplace, the first place where buyers and sellers could get together and trade private market or venture-backed company pre-IPO shares. And that made sense, right? At the beginning of a market, you pick the simplest kind of form of liquidity or financial product because it's nascent and anything more complicated isn't necessary. And so we just connected buyers and sellers and charged a commission. And that's still around. And that's by far by volume where most people get liquidity. Yeah. And so that's perfectly viable. And for some use cases, that's still the best way to do it, right? So depending on your tax situation, if you don't get the full tax benefit of what we do, and you want to maximize immediate cash, then sometimes a stock sale is the right way to go. And we frequently, our customer service reps really take a consultant's type approach. And so we refer people all the time to Forge or Zenbato or any of the private market platforms. But the other approach, but just the downside to that approach is, one, there's a brokerage commission, which is pretty sizable, and two, it's fully taxable, which, as I said, over the long term can make a big difference. The other solution are call it the single stock lenders, and those, basically they will lend against your shares. I mean, the challenge for those customers of those platforms are that they're quite expensive, and they're expensive because effectively the lender who's lending against these shares, using your single company shares as collateral, is taking a great deal of risk and has to do a great deal of work, right? So they've got single stock concentration risk. They have to value the company. So we can talk about how we value companies in our portfolio, but it's mostly done algorithmically. So we always have an immediate price for a potential customer, whereas a single stock lender has to do a kind of a traditional underwriting of the company, has to get financial information from the company in order to feel comfortable. And so it's time consuming and expensive. And typically because there's also significant risk, their loan to value ratios, the amount of cash you can get in a loan is relatively speaking quite low.
Yeah. Fascinating. So, okay. So, Shares Post is now Forge. Did you fully
Yeah.
exit that company, or are they connected?
So no, I was on the board after the merger until it went public, and I'm still a bit of a shareholder. So I've been watching its fortunes rise and fall and slightly rise again. So hopefully it finds a good home. But yeah, I think that of all the trading platforms that we look at, and one of the benefits of, or I mentioned how we value shares. So we get pricing data from most of, if not all of the kind of major market trading platforms. So by API and data feed, including from Forge, and so we can kind of see, relatively speaking, where what each of the platform does in terms of volume, like what companies they're trading the most in, how much they're trading. And so we can say, with some assurance that Forge is, typically or usually in most quarters, the number one trading marketplace, at least by volume of transactions, if not by dollar volume. I think that was the logic behind putting Forge, which at the time was called Equidate, and Shares Post together, which was to create kind of the single largest marketplace, with hopes that it would generate network effects and become the dominant player.
Hey everybody, you know what's crazy? I've been sitting on a gold mine this entire time and I didn't even know it. My Gmail inbox, literally thousands of warm contacts who already know and trust me. But here's the problem every founder faces. How do you turn those relationships into revenue without feeling like a sleazy salesperson? That's exactly why I've been using warmstart.ai. And honestly, it's been a game changer for my business. This AI platform connects your email, analyzes all your existing contacts, and helps you identify who in your network might actually be interested in what you're doing. Then it writes personalized outreach messages that don't sound robotic or pushy. The best part, you review every single message before it goes out. No spray and pray nonsense. This is relationship-based selling done right. My listeners know I only recommend tools I actually use, and Warmstart has literally helped me reconnect with people I'd lost touch with and turn those conversations into real business opportunities. If you're a founder struggling with outreach, check out warmstart.ai and use code AIFF to get $50 off your first month. Trust me, your existing network is worth way more than you think. Yeah. What's your feeling on venture capital in general? Like you said, there's new trends where, companies are taking longer to IPO, which is probably annoying for retail investors. Now you have nonprofit organizations that are going in for profit now suddenly. There's a lot of restructuring going on. And I've also heard that like people feel like there's too much money in venture capital, and so there's not enough basically opportunity for people to get returns. Like, what's your kind of take of Silicon Valley right now?
Well, Silicon Valley was for many years kind of concentrated, on Sand Hill Road. And so that's, I think if you looked at the sort of market share of venture-backed companies that were funded out of literally Sand Hill Road VCs 10 years ago, I don't know what the number was, but it was quite high, like 70, 80%. But with the growth from, over the last 10 years and the number of private venture-backed companies and their size and the demand for capital, the ecosystem has exploded, both geographically. So, it's really a global phenomenon. So I was in Brazil recently, and there's a whole slew of, institutional investors looking for access and have found various ways to deploy capital. And the amount of capital, so the size of the funds that are deploying, if you're going to, just think about SpaceX alone, the amount of capital it consumes, it's its own market, it's its own industry, basically. And so capital has flooded into those opportunities. And I also got to go back to the fundamental shift that started this whole market. So if you go back to 2009, what was the first company to kind of pursue this strategy of staying private longer? It was Google, followed by Facebook, followed by LinkedIn and Twitter, were the first 2-3 years. And that's what I kind of, came up with the idea to start Shares Post, was just like something had changed, because it had used to be the case that founders would try to get public as fast as they possibly could, almost like that was the destination, to ring the bell of the New York Stock Exchange. That was the victory lap. And what came after was kind of an afterthought. And to see the Google founders dragged into the private markets by the SEC, was a sign, and then when others followed. And when you look at it, it's a whole bunch. It's like a perfect storm of things that are driving this cost. It's regulation. So with Sarbanes-Oxley and Dodd-Frank, made it much more difficult to be a public company. It was programmatic trading, so that if you missed your earnings, in a matter of an hour of the earnings announcement, you could lose a third of the value of your shares if you missed your earnings by enough. It was the consolidation of the investment bank. So there's all these structural causes, and none of them have changed, right? So it's not easier to be a public company. It's not, it's not less of a problem if you can't predict your earnings, if you're in a high growth mode. And at the same time, it's just as difficult to be a public company, but it's become much easier to be a giant multi-billion-dollar private company because there's so much more capital that's now in funds that are focused and dedicated to late-stage private companies, and there's so much more liquidity, and there's so much more data that I hesitate to ever say it's never going to change. Maybe the pendulum swings back towards public companies. But I don't see anything but sort of an accelerating trend. And one of the most, interesting things, and I think it would be kind of the next phase of this market's growth, is 401k plans can now accept private equity can now invest in private equity. And so as a conduit for retail investors, like all the major funds, both kind of traditional private equity and venture, are all thinking about new distribution strategies to capture more assets and deploy them into this, pre-IPO space.
Are you saying then that like it's healthy, or because of the complications of like trending for like longer and longer privatized companies and also less diversification? I mean, with AI, basically, there's just like $100 billion moats around a lot of these companies where there's not really opportunity for challengers or competition.
Well, yeah. Well, so just to take the first question first, like, is it healthy? Like, it seems like what generally markets do is they grow in a particular direction until they get out over their skis, and then there's some cataclysmic problem, a market crash, or I'm just thinking what led to the current regime, right? We're talking about Sarbanes-Oxley and Dodd-Frank. Were a reaction to Enron, right? Right, was massive fraud, so there was massive legislation passed to curtail public companies and increase the amount of disclosure and the liability for management and directors. And so I think it would take something like that to reverse the course. So it also depends healthy for who, right? So it's very healthy for the VCs. It's very healthy for the people that can participate in the market. Maybe and a lot of complaints, and the reason why this change with the 401k accounts have happened is, if you look at companies that are growing, right? So tech companies worth more than $1 billion, I think it's something like 70% of them are now private companies, not public companies. Yeah. So even if you're a retail investor, call it a blue collar investor, if that's the right term I'm coining, and you're trying to save for your retirement and you want growth, if you invest in the public companies, you're basically investing in like 5 or 6 tech companies. If you look at the NASDAQ, that's like some crazy percentage of concentration of the total value, and they're not growing at anything nearly like the rate that the private growth companies and venture-backed companies are. So you're giving them access to assets and investments that they really need, but it is, the public markets and the transparency and the rules that those companies are subjected to do protect investors, right? That's half the job of the SEC is to protect investors from fraud, and it's a lot harder to do in the private market space than it is in the public. So it's people are going to get burned. There's no way around it. But maybe that is still net healthy for the overall capital market because it provides access to companies people need access to.
It's frustrating to me. I think, obviously, the accredited investor, the bar is actually pretty low, but why not just disappear the bar and give people the same opportunities where you can do these like little micro transactions? You can spend $10 on that up and coming startup that you want. I think it would be healthy for the startups. It'd be healthy for democracy, honestly. It's kind of like hypocritical that like the SEC wants to protect the investors while they're shoving sports betting apps down everyone's throat like day after day. It's like, well, how much protection are we getting here?
Well, and this is, I started my career as a securities lawyer. It was very brief-lived at one of the Valley law firms, Wilson Sonsini. And so I spent a lot of time as a securities lawyer, right? And so we spent a lot of time, studying in law school, et cetera. And look, the SEC, it's often misunderstood. Everyone thinks of them as solely as investor protection, but they really have two goals that are supposed to be sort of equal in priority. One is protecting investors, but the other is efficient capital markets. And so it's obviously these two goals are there's a tension between them. And I think, the staff and legislation has attempted to do some part of what you've said, which is, for example, there's crowdfunding rules where you don't need to be an accredited investor.
Yeah.
And so for certain investment sizes and certain sorts of companies and certain, offerings of shares, the rules are greatly abbreviated. But the fundamental point is, and this came out of literally the Great Depression, the stock market crash, right? When people lost homes and obviously catastrophic financial harm done to many, many families. The thought was, companies can take advantage of individual unsophisticated investors, right? People who don't have it as their day job to study these stocks, and so. How do you protect them? How do you find what's a simple test that you can actually make scalable across hundreds of thousands or millions of investors? And the thought was, well, net worth. That's something we can track easily. And if you've got $1 million, then probably a little something about finance, a little something about what you're doing when you invest in a company. But if you don't, and you're just investing out of your paycheck and you have no net worth, probably that means you don't have a lot of financial expertise, and maybe we can protect you from yourself. And so obviously that's very controversial. It's probably, there's a lot of good that's come out of that and a lot of bad. And no one's come up with a better rule that I know of. Maybe AI will do it. Maybe you'll have to pass a financial investment exam administered by an AI and before they'll let you deploy your dollars. But yeah.
Well,
it's a good question.
I mean, it makes sense. But maybe I'm just bitter about all these sports betting apps. It's like, they're like, hey, you seem like you like to take some risks. Well, why don't you go bet on the Portland Trail Blazers? I believe Chauncey Billups has some good card games for you.
Is investing entertainment is like betting is? I mean, And look, these rules and the legislation that govern the financial markets are not passed evenly or necessarily even, dare I say, responsibly, right? It's in patchworks, and major legislation that rewrites these kinds of rules happens, with rarely and unpredictably. Like I remember, some of the major loosenings of back in kind of the 2009 to 2010 time frame, which made it much easier. Where basically, if you were raising money for a private company, you still had to. You still could only sell shares to accredited investors, but for the first time, you could advertise to them.
Yeah.
And that had to be done. I mean, that was a major shift because that really significantly expanded the ability of founders, particularly ones that didn't have Sand Hill Road backing, to go out online and say, I'm a good company. This is, I'm raising money for this idea. And it was part of the crowdfunding, same group of legislation, but nobody expected it to pass. And it was just this, in the last 72 hours before it went to a vote, just some, I think actually the AngelList platform was a significant, backer or sponsor of that bill and made some kind of miracle happen that nobody expected. And the rules changed, and it's had dramatic effect 10 years later, but you can't predict the next time that's going to happen.
Totally. Fascinating. So there's probably not an insignificant number of listeners to this podcast or subscribers to the newsletter that might be in a good position for Collective. So when is the right time for a company to start consider Collective for their shareholders and their staff?
Yeah. So, there's a couple. I'll just talk about it from our perspective a little bit, and then we can talk about it from the company's perspective. So, with any exchange fund, kind of the most critical problem to solve is negative selection bias. So if we just accept shares of any company, private company that comes to us, then you could imagine the company, the shareholders that are most worried about the future of the company are the ones that are going to come exchange. So we kind of do it in reverse. We define the companies that are eligible, for exchange. And if you're not on that list of eligible companies, then we'll obviously talk to you and we'll put your company in front of our investment committee. But typically, we just don't accept the shares from those companies into the fund. And that gives anyone who's thinking about exchanging a certain level of comfort that there's a quality bar. And the things that that make a company eligible for us are, one, they have to have a market cap in the most recent round of over 400 million, but our average market cap is actually 1.6 billion. Yeah. They need to have, typically look for revenue over 100 million. I think average revenue for our company is somewhere around 250 to 300 million. So these are really later stage companies that we think will have a likely exit in 3 to 5 years. So we're not a Series A kind of platform or Series B. We're not a startup platform. And that's just because the predictability of the value of a company becomes much greater as it's got real revenue and performance metrics and it's a little further along. And also, again, you nailed it on the head. We need vested options, right? So a company that's only 2 or 3 years old, none of the employees have any vested options, so they can't really work with us yet. So, I think probably the sweet spot is year 5 or 6 or 7, depending upon the kind of the growth trajectory. And there's about 100 and now 140 odd companies that we've approved, and we're for exchange, and we're trying to reach out to those companies and introduce ourselves. I've been successful with about 30 of them in being onboarded as a shareholder and providing our diversification and liquidity solutions to their employees.
Yeah, it sounds like the actual members of the exchange fund, the different businesses are kind of like interchangeable as customers too. Is that kind of the idea? Is that like the customers in the fund become kind of synonymous?
Well, yeah. I mean, so in a sense, there's a really interesting community that we weren't really focused on when we started it, but what we realized is the LPs in our fund are the executives from the companies, the venture-backed companies that I see some really smart, experienced venture investors pick as their sort of dream portfolio. So we look at Sequoia, Andreessen, Benchmark, Excel, and we pick what we think of as the best companies across all of the vintages, across all of their funds. So it's really kind of a portfolio of winners and the most kind of cutting edge, most successful, most innovative companies in the space. So the club that we're kind of forming of founders and CEOs and CFOs and other executives is really somewhat unique. I mean, there's a handful of, like Sequoia and Andreessen obviously have, enough size and enough companies that they have, a far superior network. But what we're building is, I think, really interesting because when our IC, for example, goes to think about, investment in a defense area, we're now talking to a group of LPs that are already in the fund. Yeah. That have deep experience and know which companies are thriving and which companies are not. So there's a feedback loop of sorts that comes into the investment decisions or really the eligibility decisions for the fund. And we're going to see if we can do kind of more in the future to kind of connect the LPs within the fund so that they can be, kind of bounce ideas off each other.
Great. Again, It seems like it's this tight little club that how do I weasel my way into it?
Yeah. No problem. Well, Ryan, you are always welcome.
Amazing. Greg, you've had a bunch of success over the years. What keeps you motivated? Why? It sounds like you kicked off this company in 2021. Is that correct?
Well, I think we did our first external transactions in 2023. So we were building in 2022, kind of call it stealth mode, sort of. Although it's kind of the nuclear winter of venture capital in the secondary market. So everyone was sort of in stealth mode because there wasn't anything other than stealth mode. But yeah, I think for Collective, we merged Shares Post and with Equidate to create Forge. I'd kind of gone as far as I wanted to, or thought I really had any kind of value to add to that business model. Again, as I said, it's the most simple. Any kind of marketplace is just connect buyer and seller and take commission for doing that. And that was the model we started with. That made sense. But then, as the size of the market and all the data and the number of participants mushroomed, it seemed like there might be better, or at least better solutions for at least some kinds of problems than were in the market. And so the exchange fund is a good example. And so what motivates me is a desire still to solve a problem that doesn't really feel solved. So if you're even in the most successful private growth companies, it's not easy to create a financial plan or diversify or give to charity or any of the things that you would want to do with you're a paper millionaire, but so often people can't buy a house or whatever. I mean, these kind of cliche use cases, and so there's a problem that still needs solving. And I like making, like any founder, like any startup guy, I like making things work that have never worked before, or bring something new that works, that solves a problem in a different way. It's the 0 to 1, and I just kind of gravitate towards that. And once you start on an idea, then it takes a lot for you to walk away and say, yeah, this just doesn't work. You iterate, you pivot, bob, you weave, you figure out how to get there. So hopefully that's what we're doing at Collective now.
I mean, you're surrounded by so many zeros. I mean, the folks that you work with, your customers, your clients, your neighbors might be some of the most successful, wealthy people that have ever existed on planet Earth. How does that kind of affect your idea of success and wealth? And is there some kind of like a comparison?
Well, I mean, that's an interesting question. And as I, get a little bit older, a little more senior in my career, it's, when I kind of think about like how much is enough. And so I have had some good fortune in early on in my career. So I've, wealth wealth is always relative to your expenses. How much wealth do you need it sort of depends on your lifestyle. My lifestyle is relatively modest compared to some of my friends who have more exotic existences. It's fun to go to their parties, but I have a different set of needs. So I just think it's kind of a losing game to compare yourself to others when wealth wise, because there's always somebody who has more. There's always somebody who has less. There's only, one person who can say that there's nobody who has more. So unless you want to compete with Elon, there's no point in comparing yourself to others' wealth. And so I think it's, do you have enough to support your lifestyle and let you sleep at night? And then it's what problems are you working on and who are you solving those problems with? Who's in the trenches with you? So that's, the other thing is I want to make Collective successful for myself and for our customers, but also for our employees. There's a leap of faith that people take when they join a startup, and nothing would make me happier than producing a good result for them. Not just financially, but there's nothing more fun than creating something that's never existed and making it succeed. That's really satisfying.
I agree. Yeah, winners are rare. That's what makes it so sweet, I suppose.
Yeah. Well, 38%.
Cool. 38%. 15 years later.
It's if you get to a Series C.
Yeah, exactly. Cool. Are you ready for the lightning round, Greg?
Yeah, fire away. I didn't know there was a lightning round, but I'm equipped. Let me get some water before you do that.
Brace yourself. So I'm
locked in.
The listeners of this podcast love business ideas. You got any business ideas rattling around in there that won't go away?
Well, if I did, I wouldn't share them. I mean, the idea I love the most is what I'm going to do next. But I guess here, this is self-serving, I'm sure. But look, I think just focusing again on Collective, like once you have an exchange fund, the ability to do something with that exchange fund, because you're taking basically the alchemy or magic of what we do is you take single stock position, which you can't do much with if it's private, illiquid, there's no information about it. And you're turning it into a portfolio that is transparent, provides liquidity. And so you can do a whole bunch of different things about it. So again, I think, for example, charitable remainder trusts and let's talk about donor advised funds. The ability to take $100 worth of shares, contribute it or exchange it for $100 LP interest, and then contribute that $100 LP interest to an exchange fund and take a $100 write-off that you get to take over the next 5 years. So I think there's a bunch of financial products and innovation that I think is going to happen or in the private market, whether it's keyed off our exchange fund or others. And it's just, there's so much capital trapped in so much demand, the people that hold these shares in these companies to be able to have a financial plan, and what we do is part of it. But I think that there's any number of solutions that in the next 5 years we're going to see. and particularly as the Morgan Stanleys and Goldman Sachses of the world, start to embrace these kind of platforms and bring it to their distribution channel, I think it's going to grow very quickly because there's so much demand and such a large volume of assets that will follow.
Why are the kind of big, traditional players, why are they slow? What are they concerned about?
So I think they're slow in part just because the market is just coming out of a full-on reset. So 2021, we had this meteoric rise. 2022, Q1, we had a meteoric crash and 40-50% reduction. And kind of everybody in the venture ecosystem just was sidelined, as I said, by this kind of nuclear winter of venture capital. So it's only 2024, 2025 that there seems to be, a healthy marketplace is starting to develop again. And I think one of the major signs that that things are going to get busy again is Morgan Stanley just announced an acquisition of EquityZen, which is one of the major competitors to Forge. And so, when one big player buys one part of the waterfront, all the other big players don't want to be left out and kind of, feel like they're too far behind. So I think that they will get busy again. But the other thing is, big players are always, concerned about risk and liability. They have more to lose than they have potentially to gain by trying out a risky new product. So at least my belief is that we're talking with all the usual suspects, as you would expect. Everyone loves the idea of what we're doing at Collective just because they've seen, just for example, in the public markets, probably the largest player in the exchange fund space is Eaton Vance. They have announced they have over $500 billion in assets under management. And so, it's not, we're a new product in the private market, but we're a proven product as a financial solution. And so, but as I said, there's all kinds of legal and tax structuring that we had to do to create the fund in the private market space. So I think they'd like to see it scale a little. They'd like to see it have a little bit of operating history, make sure that companies embrace it. And, we'll get to a place where, frankly, they'll either partner with us or copy us. And that's just the nature of a competitive marketplace. Yeah. But we're running as kind of far and as fast as we can until that happens.
Yeah. Well, it's great, when money's moving around and people are jumping in. I mean, I remember looking at PitchBook and it was like, 2021, there's probably like 4,000 or 5,000 deals getting closed per month. And then like a few months later, I looked and it was like 118 in a month. I was like, oh my gosh, it really was a new winner.
But if you think about it, like just how much further the market has to go in terms of expansion and deepening, right? If let's say I think the biggest estimate I saw for 2024 total secondary volume was 150 billion, sort of in that range. If you're looking at a $4 trillion asset class, 150 billion is the numerator, 4 trillion is the denominator. We're just scratching the surface. And the question would be, well, what percentage of the aggregate market cap would trade if it could trade, like a woodchuck if it would? And so nobody knows, right? If it was a perfectly efficient capital market and you could, it was like the NASDAQ public market where you could just trade your shares. But you can look at the NASDAQ public market small cap index or an index of small cap companies. On average, they turn over 100% of their market cap in a year. So if we're at 3 or 4% today, maybe it doesn't go to 100, but the demand for liquidity is obviously many times the amount of liquidity that's actually getting satisfied. And as more capital comes to the market, 401k plans and more retail investors come into the market, as I said, I don't see a reversal of the trend.
Yeah. Well, and just like the products now are so much more exciting. Suddenly, like, out of nowhere, everything's AI, robots, quantum computing, nuclear reactors. It's just like, whoa, what's going on? It's great.
Yeah, no, it's great. It's a little scary because it's so much less predictable than it used to be. Particularly as you say, just mapping AI and quantum computing, which is nowhere near anything I have expertise in. But the effects of either of them is revolutionary, and the combined effects of them, you would think, nobody knows what comes next. So, last pitch for the importance of diversification. Like if you think. You can see, 5 years out into the future for your company, any company, you're smarter or braver than I, and maybe you should consider, hedging your bets a little bit and just accept the unpredictability of a technology landscape that's changing like it's never been changing before, at least in my lifetime.
Nice. I love it. Well, in conclusion, what I'm going to do is pitch you a product. You see a lot of products. You see a lot of
Sure.
investment capital get moved around. Now, I got a winner here, but I'd love to hear your take. Along
Okay.
these lines, AI, robots, but what people really like is personal workout equipment. So what I'm thinking is that give me a couple of sets of arms, kind of like Doc Ock, but just two arms that can carry on what I'm doing. That way, all day long, I could just be doing curls. Really work on the buys and tries. So like I have robot arms that are like giving me like typing my emails. It's bringing me, my snacks and my drinks. But meanwhile, I can get my human arms like super jacked.
Yeah, and I take it, is the AI then also your coach? I take it it's talking about how many sets you need to do. I was actually just reading about this in the New York Times a couple days ago about people starting to use AI to train for marathons.
Yeah.
Right, because it's the voice in your ear. Yeah, voice in your ear is always 100% of the time is attentive to exactly what you're doing, always available, and frankly super smart, smarter than most personal trainers, or more reliable. Yeah. So yeah, I think the combination of that. Yeah, but I guess the other thing I'm reading in terms of or at least some, I think you can just with the dictation and voice recognition, you can do most of your typing without typing anymore. But get me a creatine shake from the refrigerator it's the hands problem, right? Isn't that what they're saying? It's the challenge of gripping. And so I was also reading a little bit about that. Like it takes like 3 or 4 tries. It's kind of funny to watch a robot try to pick up a glass. It's just, you never appreciate your hands as much and how easily they do remarkably complex things, but it's only a matter of time.
Yeah, I mean, how irritating it is. I mean, ultimately, I'm really interested in kind of human computer interface because then you can like add arms and add things. And I want that to happen before the robots. I know 1X just released that Neo, and I don't like looking at that thing. The idea that there's like folks in the third world with VR goggles that are controlling it inside your house, and that's actually how it moves, totally creeps me out. So it's like, give me the Doc Ock arms first before we get like C-3PO in the closet, freaking me out, not even being in the kitchen. I just I'll know he's there. I don't even want that.
Yeah. Yeah. Well, we'll see. But I mean, I would guess, and it sounds like you're following it more closely than I am, but I think in the next, it's probably not 5 years, it's probably more like 10 years. I think that's the conventional wisdom, is that people overestimate how quickly new technology will be implemented in their lives, but underestimate the impact of it when it is. And so, you just look around your house and think about how the world changes when you have, robots that can train you, type your emails, get a glass of water for the creatine shake out of the fridge. What will we be all doing? Because you think about then everything else that rambles through. You look at the robot implementation at Amazon, the 30,000 people that have been laid off.
Yeah.
This, as I said, not to be, Pollyannish, but it's the world is changing very quickly in unpredictable ways.
So true. Greg, this has been awesome. Ladies and gentlemen, you can check out collectiveliquidity.com as the website. For the first time, you can reduce the risk of pre-IPO shares by exchanging tax-free into a portfolio backed by legendary VCs. This has been awesome. I want to give a shout out to breakthrough-t1d.org, which is a great organization that Greg supports. It looks like if you go to breakthrough-t1d.org, November is a dedicated month for the community, and you can give a generous one-time gift amount and any amount that you so choose.
So my son has type 1 diabetes. That's why we give to that organization. And so I'm sure he'll appreciate it. It's a good organization.
Tremendous. Greg, where can people connect with you online?
Greg at collectiveliquidity.com. So that's my email. Happy to, certainly anybody in your audience, Ryan, I'm happy to engage with, answer questions. As I said, even we can't help because it's not an eligible company for exchange. We're happy to provide introductions to, other people that can help solve problems.
Thanks so much, Greg. It's been great.
Ryan, thanks for having me. Greatly appreciate it.
This episode is brought to you by MoBurst, the AI-first growth engine trusted by iconic startups like Calm, Robinhood, Reddit, Uber, and Google. Moburst is a digital full-service mobile-first marketing agency that helps companies to scale and become category leaders. Whether you're finding product market fit or ready to accelerate growth, Moburst delivers creative, data-driven solutions that help with scale and efficiency and impact. At Moburst, we're not just guessing what works, we're predicting it. As an AI-first agency, Moburst uses cutting-edge tools to analyze user behavior, adapt creative in real time, and uncover hidden growth opportunities. The result, marketing that's faster, smarter, and built to convert. From early-stage startups to global brands, we've helped hundreds of companies overcome complex challenges, unlock new audiences, and optimize every metric that matters. At Moburst, we believe that creative thinking, advanced technology, and data are the core drivers of success at scale. If you're serious about scaling your business with precision and purpose, it's time to talk to Moburst. Visit moburst.com and let's build something category-defining together. Hey founders, let me ask you this. Are you building with AI or getting left behind by it? If you're serious about scaling smarter, faster, and bolder, you need to check out aiforfounders.co. It's your go-to resource for cutting through the noise and actually using AI to grow your startup. Each week, AI for Founders drops a sharp, no-fluff newsletter, dives deep with expert guests on the podcast, and hosts monthly workshops where you can get your hands dirty with the real tools and strategies. Whether you're pre-seed or Series B and beyond, launching something new, or just staying sharp, AI for Founders gives you the edge you need to win in 2025 and beyond. Hit aiforfounders.co to subscribe to the newsletter, tune into the podcast, and grab your spot in the next workshop. And it's all free. Build smarter, move faster, think bolder with AI for Founders. Now back to the show.